Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup Larsen.
You're listening to Top Traders Unplugged with Anders Lindell, co-founder and chairman of Informed Portfolio Management. And visualize for us, I know you've talked a little bit about it. For example, I'd love to talk a little bit about carry. Mm-hmm. I'm no expert, but obviously carry has been quite a big source of return for many people for a while. And actually my guest last week was quite concerned about some of these trades that are being put on, in his opinion, by large asset managers to compensate maybe for not making so much money in the directional arena. Because if we look at currencies, at least developed currencies, volatility has gone down dramatically in recent time, and so. Maybe talk a little bit about, how you see if you're going to drill down on sort of your carry models, how do they work? What do they look for in your world?
Well, I think as a starting point, and this is, I don't know who said that first, but carry trading is really about picking pennies in front of a steamroller.
Exactly, yeah.
And the greedier you get, the closer to that steamroller you're going to be.
Sure.
And typically it always, more often than not, it ends in tears. One typical example of that would be the carry game that sort of started in 2006, continued through 2007 and into 2008, involving obviously the Japanese yen. And that ended, I suppose, for many of the people that continued pushing that trade all the way into first quarter of 2008. That certainly ended in tears for them. What our model did was go against this to a very large extent. So we paid a little bit on our positioning in yen in 7. Late 6, all the way through 7, up until January, where the first bang came, and March of 2008, when the second instance happened, when we profited quite a bit on the sort of collapse of that carry bubble, if you like.
Right.
So that's sort of a general observation. Sure. A more, specifically to our models, there's nothing fancy in what we do on carry. Obviously, we have our own models trying to identify both carry in the traditional sense of the word and changes in carry and a few other things related to that. But the most notable point with our model is, again, that is relative. We're not interested in the absolute level of carry per market. We're interested in the deviation from the longer term average carry, if you like, that's been delivered by a particular market in relation and risk adjusted and things. So just because we have a situation where statically over time, Kiwi and Aussie has probably delivered better than most other markets over the past 10 years or 15 years, whatever. And that doesn't mean in our books that we necessarily from a carry perspective always have to be long those markets, because we're interested in how much does carry in Australia today differ from what it has been on average over time. And that makes a big difference when you trade like that, rather than trying to evaluate the sort of absolute opportunity set.
So in a sense, it would almost be like, if I'm right, going the opposite way. So as this carry opportunity deteriorated and some people levered up to get the same absolute return, your models would actually go the other way and de-lever because the opportunity was going down.
That would be entirely reasonable, yes.
Okay. Interesting. In terms of these strategies, macro valuation, risk premium, market dynamics, for example, I mean, are there any of these that are more dominant in the portfolio or in the program sort of structurally?
Not really. If you look at and inside each of those boxes, you will find a number of different factors. What we try and do is here too, to try and be unbiased. When we design our risk factors, we, almost per definition, they're designed to be uncorrelated with each other. Central distribution and all that. They are designed and we only introduce them given that they contribute enough in terms of forward-looking sharp expectation, if you like. And, a typical risk factor may deliver something like 0.1, 0.2 in expected sharp. Now, as they have qualified for the model, we believe they are sound. We believe they will continue to deliver over time this forward-looking sharp, and hence we think it is relevant to actually equal weight these risk factors. We don't believe in altering the weight based on historic performance or akin to increasing the weight on stuff that's been successful in recent times and decreasing weights on stuff that's been unsuccessful in recent times, because that again would lead you into a situation where you basically increase your bet on everything that's gone well over the past time, so you become a momentum trader. Sure. Obviously, if things continue to underperform over an extended period of time, you should start asking yourself the question, why is this? Or is it not properly defined? Has this particular thing all of a sudden become arbitraged away? Or are we looking at it from the wrong perspective? And those questions will go into the research process. Right. So at a factor level, everything is, as a starting point, pretty much equal weighted. Right. If you look at the main themes, value, risk premium, macro, and market dynamics, the strategy will come out as having a little bit of a value bias. Generally, and this is pretty natural as we're trading on sort of mean reversion to either longer term equilibria or value, and we're using fundamental information. So you should expect this to have some degree of value bias, not a strong one, but sure. A little bit.
Sure. And looking at, if I can define it like that, a model is something that could generate some level of signal and thereby some kind of scoring impact on the overall portfolio. How many of these quote unquote models would you say that there is combined in the whole strategy? Because it sounds like there are a lot of moving parts that can influence each of the markets and the themes.
There's a little over 40 different risk factors or some models, if you like, that goes into this.
Right. And given all of your experience, just out of curiosity, is there any indicator when you look at the global sort of economy that you like better than others? Do you think is more reliable than others?
It's a matter of horizon. Personally, I do like traditional valuation metrics. I think ultimately they are reliable. They make a whole lot of sense from a fundamental and theoretical perspective, but it can take significant time for them to play out.
Right. How frequently do you run the model? Is that because obviously some of these factors don't change every day, maybe let alone every week? I mean, how does it actually work on a sort of on a running the model overall basis?
It is actually run on a daily basis, right. and the model is re-estimated on a daily basis, because what goes in, there might be an odd price here, there might be an inflation number from there. So if you look at the world today and all of those markets that we trade, it's likely there's going to be a couple of new inputs at least per week, even on a daily basis quite often. Obviously, some periods going to be more intense than others, but also as market prices move around, the model will observe this and try and adjust positions accordingly, because what the model comes out with is desired exposures per market on a daily basis. And if market has pushed us into a direction where that exposure has grown or contracted relative to what the model wants it to be, then some level of corrections will have to be done. So there's a little bit of trading actually going on a daily basis, but compared to most other managers in the traditional systematic space, I dare say our trading intensity and portfolio turnover is very, very low.
Right. Now, if I'm not mistaken, you're not really using a traditional stop loss in the model as many people do in the systematic space, at least. Tell me philosophically a little bit about why that is, and when not doing it that way, how do you to begin with determine the risk for new trades, if I can put it that way? Not so much for how you manage the risk overall, we'll get to that, but just sort of the sizing issue when you put on new trades. How does that work when you're not sort of utilizing a stop loss?
Starting with stop losses, I think most of the people that actually use stop losses are exactly people or firms that model individual instruments in their own right. So basically, they're building a portfolio out of 40, 50, 100 traded instruments, and they can assign a stop loss to each individual position.
Sure.
So if they stop themselves out of soybeans, that doesn't change anything for their positioning in base metals.
Sure.
Or they stop themselves out of Canadian govies, it doesn't mean anything for the S&P futures. Whereas in our setting, everything is modeled against everything else.
Right.
So the positions that we take are, entirely dependent on all of the other positions. So if we identify, or if we were to identify a particular instrument having taken significant losses over the past period, and we would say, all right, so let's stop ourselves out of that one. That will immediately change the entire portfolio, because not only do we have to kill that particular position, we have to alter all of the other positions with wholly unpredictable results in the end. We may, do something inherently smart by doing that, or it may be, incredibly stupid. Additionally, the way this model works is that, we have to accept a certain risk of drawdowns on individual instruments and indeed on the whole program for it to play out. Because what this model does is, take something very, very simple to exemplify. If we're looking again at a PPP valuation model on currencies, and that one identifies a particular currency, let's call it the Swedish krona, right. That starts getting, underpriced in relation to value. We would start buying that. In all likelihood, that currency is going to continue, the Swedish krona is going to continue to become even further underpriced in relation to fair value, right, before it starts mean reverting back. During that period, we will start almost immediately to buy, and then we will continue buying and increasing that position all the way to the trough. And that means that in that period, when we build a position, we almost per definition, we're going to take losses.
Sure.
To be max long at the trough, and then start profiting from that.
Yeah.
Now, this can play out over a couple of different scenarios. A typical scenario that would cause losses for any model like this, and this is certainly true for our model like this, is a traditional sort of value trap, which is almost exactly what I just described. These are things that will play out over a longer period of time, and you will build your position and take further and further losses. Yeah. We're okay with this to a limit or to a degree. I'll get back to how we try and compensate for that. But it wouldn't necessarily be meaningful to take a stop loss in such a scenario, because what will happen is we're going to pay the price to build the position to be long when it starts mean reverting, but we'll kill the position before that starts happening. The other scenario is, very, very fast moves in the markets. Let's say something like 1987 would happen again, or the Fed hike in 94, or long-term and Russia crisis in 98, or whatever scenario that you can imagine, where all of a sudden, this is typically centered around equities.
Right.
Markets, sell off 10, 15, 20% in a very short period of time. August 2011, for example.
Right.
So here's a situation where we're going to face, a steep loss. If we come into this sort of in not correctly positioned, we would face a steep loss, and almost inevitably, what happens on the back of that is that markets swing back,
right,
relatively quickly. These are not, scenarios that continue for quarters or years. Typically, they swing back pretty quickly. So what you're going to accomplish with a stop loss in a scenario like that is that you're going to lock in profits, and you're going to be your position is going to be too small when it swings back. So from that perspective, too, stop losses wouldn't be productive. What we try and do, though, to limit our exposure to various type scenarios is that we're setting limits to how big we can be on each market.
Right.
Exposure ranges, we say. So we say for the full risk program, we may never be longer than X% or shorter than X% in a particular market.
Right.
So that's a limit that the model has. Additionally, at risk factor level, and this is part of the portfolio construction process, we actually try and limit, or not try, we actually do limit how strong signals can go into the final portfolio construction stage.
Right.
So let's say that you have a signal of, let's call it 1.
Yeah.
And you would then take position in proportion to that 1.
Sure.
And the 1 here, by the way, would be standard deviation. So it's entirely, reasonable to take a position that is, X against a single standard deviation signal.
Sure.
Now let's assume the opportunity moves to become much more significant. So we end up in a 2 standard deviation signal,
right,
which would be, immensely rare. But, as we all know, such things happen more often than statistics prescribe.
Yeah.
So our model would then like to double this position, pretty much.
Yeah.
Here's where it starts getting iffy. We're still okay with that, but if you double that again, let's move from 2 to 4 sigma or standard deviation events. They wouldn't happen often in a person's life.
Sure.
Would you be comfortable doubling up again? And here's where we start, taking a step back and say, yeah, the model is probably right. This represents a 4 standard deviation scenario as a model is defined. And really, we should take position based on that. However, knowing that would be a very large position, we will also expose the model to a significant risk of drawdown based on, basically timing. Because the model may be off with, this thing may not mean revert for another 2 months or 3 months.
Sure.
So the likelihood of a drawdown would increase dramatically. So here's where we start limiting. At some point north of 2 standard deviations, we actually start limiting the strength of signals that are allowed into the portfolio construction stage.
That makes sense. Yeah. And how long are your trades actually on average? Because they seem long term.
General average would be about a year. On the currency side, a little bit shorter, 9 months, let's call it. And on the asset side, a little bit longer. But on average, yeah.
What's the most difficult sector to trade actually based on your method? Do you find? I mean, you mentioned August 11, and we all know equities were tough, in particular because of the uncertainty about the U.S. default risk. is that a particular difficult sector to trade when these things happen because they react quickly, or?
Yes, equities in general, and in particular relative equities, with our way of modeling, is quite difficult. Currency markets, I wouldn't say they're easy, but it's a little bit more straightforward. You get, the responses that you're striving to get.
And what do you think drives these relationships that you profit from? I mean, is it more economically sort of changes, or is it investor psychology, or is it just human behavior? Meaning, as I've mentioned before, things go in cycles and we tend to come back to the mean. What have you observed over the years?
I would be inclined to say all of the above.
Right.
But I think it's good. Well, actually, I think it's a combination of different things. One way, to exemplify would be to step back to the fall of 2012, when they started talking about the introduction of a quantitative easing program down in Japan.
Right.
Obviously, a lot of people were pretty quick to respond to that, and the likelier it became to them based on their analysis of the political and central bank situation. People started running ahead of themselves and take position on this. And running ahead of themselves is probably the wrong expression there, because a lot of people did that with significant profit.
Sure.
But as that continued, some of the earlier people that were earlier in probably started taking their profits and saying this has run its course, whereas others, once it has sort of trickled down to the more general investing community, they continued in that same direction. Whereas our models, they wouldn't hear what the open mouth operations by Bank of Japan. They would only note this when it starts materializing in hard data.
Right.
Which means that here's a trend in markets established by people trying to anticipate what Bank of Japan is going to do, and how the currency market is going to react, how the fixed income market react, and certainly how the equity market is going to react to this, and what corporate profit is going to be like in Japan going forward. So based on that, and this is something that typically happens, is that people extend what initially seems to be reasonable trends, they extend them way too far. And then when the final realization comes through that, hey, the corporate sector in Japan isn't going to be as profitable as they could have been based on this, and the yen isn't going to 180 against the dollar, right, or whatever number they had targeted,
sure,
then you have a reversal of that. And this is, typically what a model like ours would try and profit from. So generally, investor behavior, people trying to not only follow the trend, but people generally overextending it far beyond the point when it has contact with underlying fundamentals.
Sure.
That's one major point. Another major point that I want to mention is actually time horizon or investment horizon.
Okay.
People may trade in or out or create trends, and prices may deviate. It's just noise over shorter time spans. And we're trying to step back and avoid that by explicitly trading and holding positions a longer period of time.
A couple of things comes to mind when you say that. I mean, in one sense, it actually is a great injustice, not just to your strategy, but to many strategies, you could say, is for investors to look at these things on a monthly basis and kind of judge you on based what did you do last month, because what you're really saying is that part of the success is having the ability to take a much longer view and not be concerned about an adverse move over the next few weeks, because it's going to work out maybe over the next few months. But I also wanted to ask you a little bit, just position sizing. Is that the secret sauce, do you think? Meaning that a lot of the themes that you end up in, and I imagine a lot of the strategies and positions you end up in would be somewhat similar to other global macro managers. But I do note that you've done quite well compared to your peers. And do you think position sizing is part of the success, that you simply manage the risk differently maybe?
I think there are several parts to it and several moving parts here. What I tend to say to clients that want to evaluate what it is we're doing is that 9 out of 10 clients, for good measure, I'll throw in the consulting community here too. Right. They are spending way too much time focusing on what we refer to as those risk factors. Right. They want to know them all, and they're looking at purchasing power parity, and they want to understand exactly how we build that particular factor, while noting that academically speaking, PPP has a mean reversion time of 50 years. Clearly not investable. Sure. And they're spending all of their time trying to understand, do you have the right alpha sources? Are they advanced enough? Are they sophisticated? Do they differ from your competition? And, that guy over there, they also have PPP factors. Well, those alpha sources, risk factors, yes, they're important, obviously. They're very important. But risk and portfolio construction, respectively, contribute, to the same degree to the final result. So I would say, spend 1/3 of your time trying to understand what we do on the alpha side. The other third you should spend on risk management, and the third you should spend on understanding our portfolio construction, because it is a combination that yields the final result. And in each of those areas, I would say you will find differences between what we do and what a lot of other people do. Some people may have almost the identical setup when it comes to alpha factors, but in all likelihood, and to my knowledge, they would differ in either of, or indeed both, of portfolio construction and risk management, etc., etc. So, as you mentioned, position sizing, that's one area where we do things that's different from most of the investing community, when we say that we want positions that are principally proportional to the perceived opportunity. Another area where we would differ clearly is the way we construct the final portfolio, by way of transitioning signals into positions. Most people would use some form of more or less traditional optimization scheme there in the middle, and they would, for the most part, make use of the correlation structure when they construct their portfolio. And here's where we differ. We don't use the correlation structure there. And to exemplify, if you have positive views on both of the Australian and New Zealand dollar, right, and we know they're strongly correlated, sure, it is relatively likely that any traditional or almost traditional optimization scheme would like you to short one to go long in the other due to the correlation structure. This is fundamentally wrong, we believe, for a couple of reasons. A, if we have a positive view on two assets or two currencies, we want to be long both, because we're not forecasting the correlation structure. And it would be fundamentally against our principles to short something we have a positive view on. Two, that optimizer will relatively often push you into what is referred to as corner solutions, right? Yeah. And that means that as something then change over the next week or month, it is not unlikely to want to push you into the direction of another corner. And that will, if you take position based on that, then that will cause a lot of trading costs for you. Right. You will change your positions quite a bit. Finally, if you do this, shorting one to go longer the other, your bet concentration is going to increase quite a bit. Right. And neither of these three are sort of traits that we're very comfortable with. So indeed here, we don't use correlation structure. Simply, not simply, but we transition signals into positions. And then when it comes to the risk overlay, then we're using the correlation structure.
It's very interesting because it seems to me that maybe unlike a lot of people doing relative value, where I think to some degree, they're trying to take out the volatility of their returns by doing, relative value. What you're doing is saying we're doing relative value, but we're actually okay with having volatility in our returns because we can't remove volatility from inherently underlying assets that are volatile.
Mm-hmm. Yeah, that's an interesting observation. I think another way of looking at it is to say that the volatility that we get, and certainly some of the drawdowns that we, as everyone else gets, they are the price you have to pay because you don't have obviously perfect insight. In our specific case, we believe we have the right positions, but the timing, we don't really know when markets are going to start moving back to that sort of longer term equilibrium. So we have a problem of timing, and that's why we simply say we start building positions, we increase positions as the opportunity increases, to a good degree.
Yeah.
And meanwhile, we're not happy, but we're prepared to take the losses to build that position, and we are happy to take we have to accept the associated volatility because again, we don't know when the market is going to turn.
Have you ever had to override the models?
Not the actual models. We wouldn't override the models in the sense that we would alter, the positioning or such. What we can do, and we have done on occasion, is that we can we can de-lever the entire program.
Yeah.
And this is a measure we would take after obviously careful consideration at Risk Management Committee, and it would basically be based on a view on the functionality of markets. So the best example here would be, September, October 2008,
right,
when we delivered, quite a lot.
Yeah. Now, the next area, and I probably won't spend too much time on it because you've already talked quite a lot about it, which is great, and that's really sort of risk management. And I've just got a couple of things I wanted to touch on, and that is, how do you define risk? What to you is what's a good measure of risk in your opinion when you look at these type of strategies?
Well, there are sort of two answers to that, at least. What we control for at program level is actually expected volatility.
Right.
And inside the model, as I mentioned, we're limiting, certain signal sizes, etc.
Sure.
This is based on tendency drawdown akin to you're really focusing on sort of tail behavior, which leads to sort of expected shortfall type thinking. So this is what we do. Now, do I believe that expected volatility is really a good measure of risk? Well, no, I don't. What I would like to do at some point, and this is something we've talked about on and off for the past 8-9 years, whatever, is really to start looking exclusively at the expected shortfall and really to build models that would take that and only that into account. The problem with that is that if you're targeting and limiting, controlling, I should say, exclusively for expected shortfall, the model may well find itself in a situation where it says, that left tail is about 0 today, so I'm happy trading at 40-50% expected volatility. So the volatility of your volatility, and certainly on the upside, traditional volatility, would increase dramatically. Or has the potential to increase dramatically. And this is not something that would be, shall we say, immediately accepted by clients.
No.
So why we then target the expected volatility? Well, it is a measure, and for us it has actually worked. It is a measure to make or to protect the model. I should say, because the model is very slow moving. The model is blind to political statements, central bank speak, etc., etc. and to sudden turns in the market that cannot be predicted or measured by fundamental data. So the model is slow moving, blind to a whole lot of things. So what we then need to do is to protect the model by using a method to pick up on, peaks in or dramatic or bigger increases in market volatility. Because either we're in a situation, volatility spikes, either we're in a position that we actually profit from that, in which case, it's sensible to take some profit, delever a bit, and then wait for volatility to revert back down and start putting positions on again. And nobody's ever gone poor by taking profit. So in those scenarios, it's probably a good thing. It could be that we come into a situation where we have the opposite positions, we actually lose too much on it. Then it sort of resembles a bit of a stop loss.
Right.
Because if volatility spikes and we have wrong positions, then obviously we're going to start losing money. And the model will then start delivering. So it will reduce the sort of further loss of capital, if you like. Unfortunately, it has the same characteristic as a stop loss when markets turn back up again, because it will then have delevered.
Yeah.
So once markets start reverting back up again, it will come into that with two small positions. But that's the price to pay.
Right. What keeps you awake at night? Meaning, what is the risk that you fear the most? Because at some point, there is obviously something that you can't guard against. Even with the most elaborate strategy and risk management, what would that be?
Generally speaking, I sleep very well. My wife would be the first to testify to that.
Sure.
But what, if anything, would keep me awake at night? Situations when markets quite apparently behave irrationally.
Right.
And certainly when they continue behaving, and pretty much everyone would agree, they continue behaving irrationally for some time. Because then we find ourselves in a situation where, we cannot expect the model to act in a predictable fashion. Whether we make money or not,
Sure.
or lose money or not, is entirely random, such a scenario. And we're not in the game of sort of taking big positions in, and we do take pretty significant positions in this program.
Sure.
It is not really built to collect on random behavior.
Right.
And these scenarios, they do occur from time to time, where we'll focus on something completely different.
Sure. Do you think the risk of markets behaving completely irrational, has that increased in the last few years with so much involvement from politicians and central banks? Or is this just part?
I think most people looking at their lives trading experience, my age, we'd be talking about 20, 25 years, they would probably say that's true. On the other hand, if you read whatever book on the topic, and you go back to the Dutch tulip mania, or
Sure.
Market crashes in the late 1800s, etc., I'm not so sure that market and investor irrationality has increased over time. Okay. I think we feel that at the current time,
Sure.
probably, but that's only because our time window is too short.
Sure. I want to jump to the next topic, just again, very briefly. It's just a little bit about drawdowns. I want to ask you a little bit about what one should expect in terms of drawdown from a strategy like yours, but also want to ask you how you cope with being in a drawdown. I noticed that obviously your drawdowns are not that large, if I can put it like that. But the emotional roller coaster that we tend to go in if we are in a drawdown, especially if it's a deep one, but also if it's a long one, can be, that's part of what's being hard, I think, about being in this business. So I just want to sort of maybe ask you a little bit about how you cope with these things emotionally. And maybe that's not from a recent example, but maybe sort of over your career.
I think a main source of strength in this type scenario is that we are systematic.
Right.
Had we been discretionary traders, and you would face some of the drawdowns that we've had, and probably our largest drawdown would have qualified for us losing the money if we been on a prop desk almost immediately, or at least seeing it halved or whatever taken away. But as we are systematic, we have to seek comfort in the fact that we believe the model is right over time. We believe this is temporary, and eventually it will come. It will come back. If we start tampering with the model, or we start sort of adding to delivering by discretionary measure or such things, then in all likelihood we're only going to make the situation worse. So this is a program that we traded for a very long time. We put enormous amount of manpower and brain power into the development of it. We believe it has proven itself. So the main thing here is really to seek comfort in the fact that we're systematic, and then this really comes down to one of the reasons for being systematic in the first place is to avoid exactly this emotional behavior. You would be most inclined to kill your positions just when it feels the most uncomfortable.
And this is often what investors do with managers, in my experience. They often redeem right at the worst possible time, which is similar to us having a position or a period of negative performance. So the question is, Anders, and I know you've done, in my opinion, quite a lot of and a quite unique way of bridging the gap, but how do we transfer this comfort and this belief that you have in your own system through the difficult time to the investors? Because I know you've got a special group of people inside your business, working very closely with your investors in terms of transparency. So is that the way forward, just being extremely open about it?
Yeah, I think so. We're the most comfortable when our clients have almost complete information. They know what we're doing. They know the model. They know how it works, and we could go pretty far in that discussion with clients just to make them fully understand what it is we do, how we do it, why the positions are taken, etc. I think there's no alternative really for this type of strategy. We need investors that have confidence in what we do based on knowledge of what we do. And that can only be accomplished by complete transparency. And the more client dialogue, the more we have prior to initiation of a mandate and also ongoing, the better.
Absolutely. Now, next topic I have is research. And now, generally, investors they want managers to innovate and come up with new things, and evolve, but they don't really want them to change at the same times, which is sort of quite difficult, I guess. How do you balance these two things? And what does research? How does research look like inside IPM?
Well, I touched upon our frequency of changes just briefly earlier. Obviously, we have to evolve the model. It has to improve. We have to add new components, but there's nothing built into it saying that we absolutely have to change just for the sake of it. What we're trying to do is to add where we find weaknesses. We have to add where we find interesting opportunities, all within the same setup. So what we wouldn't alter is the fundamental way of doing things. We wouldn't take to take something ridiculously extreme, we wouldn't take a trend following component and just adding that, because it's outside of our self-imposed limitations on what we do, philosophy, if you like. So there's going to be a few changes over time, but it's a gradual development. And this really reflects the research process also, because the research process here is very, very thorough. It would be rare to find something newly introduced that hasn't been in the works for 6 to 18 months, at least 6. Just finding the right data sets, grabbing all of the data. By the way, starting even earlier, identifying what it is that we think can fix whatever problem we have identified, coming up with a couple of ideas, identifying the prior assumptions that we want to lock away and measure the ultimate performance of this new thing against, to verify that it's actually doing what it was supposed to be doing, rather than just being a sort of general source of alpha. Then finding data that is reliable long-term enough. We can't build something based on 3-4 years worth of data. It's got to be a long-term history, and it's got to be clean data.
Sure.
And then building the model, testing it against all of the other factors. All of this is a very time-consuming process.
Yeah. Are there any particular interesting areas that you're looking at right now that you think could be benefit you in the future? Without giving anything away, of course.
Then the short answer would be yes. No, there are a couple of areas. Generally speaking, we're trying to broaden and deepen the model at the same time. So in terms of broadening of the model, we'd be looking at, or deepening of the model, I should say, we'd be looking at new factors. This is probably sort of less interesting for your listeners at this point. Broadening of the model. One good example is what we did last year. We introduced emerging market currency model. What we're looking at right now is broadening the model by way of potentially start trading fixed income curves or yield curves explicitly. We do have commodities on the research agenda, although it's not the highest priority at the current time.
Sure.
In terms of risk management as opposed to risk control, we're hard at work at the current time to be able to rebuild the model such that we're able to measure what sort of exposures we have in the dimensions of global risk factors. So, what sort of beta risk do we have? What sort of duration risk? What sort of inflation risk or exposures? All of just identify how are we exposed on a number of dimensions, and then in the next step, how and what and how can we do to control for that?
Sure. How do you make a back test meaningful? Because there's never been a bad back test, if you know what I mean. What is important when you look at the results from your research and you look at the test of the model? What in particular are you looking for to verify and say, yeah, this is actually not just something that looks good, but it's something that is robust? Because I get the sense that robustness is really important for you. How do you look at a back test and realize that this is pretty robust?
I think as a starting point, we do what probably everyone else do, or in some instances claim they do. You test on a limited set of data. You lock away other sets of data, and then you verify your results by running on that part of the data that it didn't use to calibrate. Another aspect that we think is important is to not over-calibrate and to not over-engineer your model. One example of that would be that, as we mentioned earlier, we're trying to use as full data sets as possible. Yeah. We're not limiting ourselves to any particular window, whether rolling or short or long, generally speaking. Because it would introduce biases and it may amount to over-engineering. That's also important. But I think in the end, two most important things is to, I hesitate to use the word scientifically, but let's call it scientifically, verify that your thesis is sound and robust. If you come up with a sound thesis and is supported by theory, then if we have independent support in academic research, etc., that this is sound and it is right, then we should. That's a strength. And finally, trying to set up your assumptions and priors for the new factor. If we say that, and I'm just going to use a bogus example, if we say that we've identified that our carry model is really bad. So then we set off identifying a new theory that we should be able to trade on. Then we need to verify that here's what we expect from it. It should pick up on carry. We should be able to verify that it picks up on carry. It should do X, Y, and Z. This is written down and locked away. And once we then built this factor and it's tested and calibrated and all of those things, then we need to take a look at the actual outcome. Does it deliver what we thought it was going to deliver from the very beginning?
Right.
If it does, and it's passed all the other tests, then it's probably a sound and robust factor, or there's a good likelihood it's going to be.
Sure.
If it doesn't, it may very well deliver strong alpha anyway. But if it doesn't, then our hypothesis was actually wrong.
Yeah.
And then it shouldn't go into the model.
Sure.
At least not in that form and based on those results.
No, absolutely. Now, the business side of the firm, just a couple of things that I wanted to touch on. Not necessarily the usual questions you get, but overall, of course, you've done really well. The business is growing or has grown a lot. But I want to ask you two different things, and that is Keyman risk. Do you consider yourself having a Keyman risk, or have you managed to eliminate that also by being systematic? And the other thing I wanted to ask you about is, have you thought of, or maybe even implemented, some kind of business succession plan, even though I know you haven't even turned 50, but we need to consider these things from time to time?
I think there are at least two aspects to Keyman risk. One of them is that one should talk about. One of them is time, and the other one is probably confidence or perception. Given that we are fully systematic, given that there is a large number of people working on the models, etc. Frankly speaking, if I or any other senior person in the firm were to walk out the door tomorrow, over the coming year, 2 years at the very least, the firm is going to continue delivering pretty much the same results as one could have expected it to deliver without those senior people having left. Over the longer term, you may have a question as to whether the organization or the remaining organization has the ability to continue developing the business and the models in the same fashion as earlier. But that means you as an investor into this shouldn't be too concerned about Keyman risk as it applies to the handling of your money in the shorter term. Because if X or Y or I or someone else senior were to leave today, you have a lot of time. You can sit down and take it quite calmly and evaluate the situation over the coming 6 to 12 to 18 to 24 months and say, hey, it seems that the organism is healing and repairing itself, or it's not. So there's no urgency in this. The other aspect of Keyman risk has probably more to do with confidence and perception. And this is something you cannot do anything about. Most investors out there, they would invest based on confidence in a number of senior people, frankly. And if they leave, then that confidence is gone, and it's a process that will take a considerable time to rebuild for whatever people remains in the firm. So I'm sort of saying both yes and no. There is a Keyman risk, but I think if you look at the proper management and handling of client capital that's been entrusted to you, I think Keyman risk for this firm is not a big issue for you as an investor. You have a lot of time to evaluate the situation. You don't need to do anything immediately. You can sit down and evaluate over the course of several quarters before you take action. Succession plan? Well, not really. I know we have a lot of There's been a lot of written about succession in hedge funds over the past few years, and I know a few of the investment banks have been writing analysis on this. I know of relatively few personally hedge funds that have successfully done this. The obvious well-published example would be Caxton, I suppose. There's no formal plan in place.
Sure.
On the other hand, we just discussed the Keyman risk, and we're seeing, when people can see what now happens at the firm. I've sort of left the day-to-day operative responsibility for again, day-to-day management of the firm, but I've certainly not left the firm. So.
Sure. No, and that is in a sense a kind of succession planning.
Right.
Last question on the business side I wanted to ask you is just that obviously you've had tremendous growth, but I'm sure it hasn't been necessarily plain sailing along the way. Is there any challenges along the way that you can think back of as good examples of sort of things that was tough at the time and sort of how you overcame them, or has it maybe been plain sailing all the way?
I wish. No, it hasn't. As with everything, it goes up and down. I think one period in time when things didn't go the way we liked it to go was in 2011. We had this drawdown in August 11, right. Or mostly in August 11. And a lot of people started thinking, hey, is this reliable, or is IPM indeed yet another of these systematic global macro traders that ultimately blow up? There's been a few of those examples.
Yeah. Sure.
And in addition, my co-founding partner principally left the firm at the time. We worked together for a large number of years. He'd gone slightly more passive just prior to 11, but in the end, late 11, he more or less left the firm. He retained a position on the board, but not very active. So people held back given these changes, and given the drawdown, people held back, and we even lost a couple of smaller accounts. But the losses aside, what it means is that your fundraising activities going forward, they do get delayed.
Right.
So that's sort of a disappointing, to be expected.
Sure, yeah,
result.
exactly. Yeah, absolutely. Now, you have obviously been in many meetings and due diligence and phone calls and had thousands of questions over the years. But what do you think is the question that investors should be asking you, but they never really do? Because you alluded to earlier that they all seem to be very focused on something, trying to understand things that actually you didn't feel were so important. But what is really important for investors that they should be focusing and understanding, do you think?
That's a tricky one. Again, over the past 15, 16 years, I've had a very large number of questions. Mm-hmm. I honestly, I think you're touching really upon the most important part. I think people should really focus on trying to understand the components. You always get the question, so how do you differ from your competitors?
Sure.
Well, the competitors don't tell me what they do, so you're probably in a better position to tell me, for starters. And B, I can't single out any one area, but you should take a more holistic view and look at the whole. Mm-hmm. How does all of these components that we're talking about contribute? How are they put together as a whole? Mm-hmm. Because what we're talking about is a system that is sort of purpose built to do just this, and all components have been tailored to fit this particular structure. We could principally have built this same alpha factors but traded instruments standalone. Why don't we do that? So how do you put all of the pieces together? It's like a puzzle. Yeah. You may have excellent, good-looking pieces, shiny and all of that. But if they don't fit together,
right,
if they're not designed to fit together, then irrespective of how good the alpha sources are, they're not going to deliver.
Yeah.
So I think that's really critical. How do you put all of the pieces together?
Interesting. And maybe a little bit on that note, I'm just curious, sort of just a spur of the moment here. If you were going to invest in another hedge fund, and maybe you do, but what would be the single most important thing for you to ask that manager? And I don't want you to go into any details as such, but just the hedge fund industry from the inside. So if you were going to invest with someone, what would you focus on of all of the things that you could ask?
I'm not so sure I would focus on any one particular question. The most important thing for me would be to meet with the founder / the driving force in the company, and really convince myself that this is a person that is sufficiently knowledgeable and that my gut basically says I can trust.
Yeah.
Is this a person that I would irrespective of what he does, irrespective of the sort of strategy, I need to feel that this is a person that really knows it, that same as we do, has put all of the pieces together in an intelligent manner. And for me also, it needs to be, he or she needs to prove this is repeatable. And why is it repeatable?
It's really interesting you say that, Anders, because I think that those qualities that you mentioned there is probably completely lost, I think, in the normal due diligence right now, where maybe 1 or 2 analysts come out, they sit with you for not enough time, they ask standard questions, they use a tick box mentality where it's actually not so much about the gut feeling and the personal, it's more about do they fit these boxes, and then they have to convey it in a report to people who've never met you or the manager, and trying to convey these important, which is quite sort of personal and emotional things that I agree with you is really the important part, because at the end of the day, whether you're systematic or not, investors buy people. It's the people behind it. So, by hearing you saying that, I feel strongly, interestingly enough, which is partly the reason why I do these podcasts, is for people to connect with the manager, hear the passion, and get a feel for the person rather than just a written due diligence questionnaire. So interesting point.
No, and with a firm like ours, obviously the person and the staff, who's working here, and but as you say, I wouldn't go so. Obviously, I cannot go so far as to say that all of our clients spend too much time on focus on DDQs. But
sure.
Indeed, it has become a bit of a science, or pseudoscience, if you like, where you tick all of the boxes, you do your own DD, then you hire a consultant that comes and does his DD, and they also tick the boxes, and then you just put it together. But as you and I touched upon, I think there's too little focus on, let's call it the human aspects.
Yeah, absolutely. Last section, Anders, we're on the home stretch now. I call it general and fun, so it's a little bit about sort of not specifically to your strategy, but just generally sort of what do you think nowadays it takes to become a great fund manager or trader? What are some of the personal traits? Because as we alluded to before, these are the things that we look for in making a decision or making a connection with someone. But what are the things that or what does it take nowadays to become a great manager such as yourself?
I think that since the world has evolved quite significantly since 1998, I mean, just one observation, very, very sort of anecdotal. 15, 20 years ago, you could start up a hedge fund with, coming out of a prop desk or whatever, having, a great strategy. You rented an office, a Bloomberg, two guys, and you got on with your trading with a couple of $1 million. You may have got seeded 20, 25, and you can actually build a business from that point. Whereas today, the market's gone so crowded, the regulatory requirements are so high that if you don't start pretty much with a full setup of people, and that may be anywhere from sort of 6, 7, 8 people up to 15, 20, whatever, with seed or starting capital in the order of magnitude $100-200 million, then it's going to be very, very difficult for your business to take off, irrespective of how good your strategy actually is, and how smart you are, and unless you have a confluence of events, you're coming out of a bank and they actually give you a couple of hundred just as a parting gift, or you're being one of the sort of tiger cubs and you get seeded by Mr. Robertson himself or such. But those would be the rare exceptions. And additionally, to start something today, given all of this, requires probably a lot more hard work and probably a lot more discipline than was actually required 20 years ago.
And luck, I guess.
Luck is always there, yes. You can help yourself to some luck too.
The harder you work, the luckier you get, as they say. Is there any personal habits that you have that you think have contributed to your success? We know that people like Ray Dalio puts a lot of emphasis on his daily meditation practices being part of his success. I mean, do you have any personal habits that you do that you think are important?
It's very hard. You should probably ask my wife. But,
I'll get her on the next series.
Exactly. No, but I think generally speaking, and whether I'm better than most at this or not, I'm not sure. But generally, I am relatively disciplined. When I started taking up running and stuff again, a few years back, I actually get out of bed at 5 a.m. and do this, because that's the only time of the day that I am 100% sure that I actually have the time to do it. So I got nothing better to do. Well, obviously sleep, but I got nothing else to do at that time. So, a little bit more probably than average discipline, I would say. And that's very helpful.
Yeah. What's the most difficult thing that you have to deal with as a hedge fund manager today, do you think?
There's any number of things you can mention, ranging from the ever-changing regulatory environment, which is on my list, but that's sort of technical.
Sure.
That's principally a problem that you can solve by way of throwing money at it. What you cannot solve, though, that is related to regulatory, but that is also related to sort of perception and other things. That's on the investor side, where looking at the Dutch market as an example, where investors have, I wouldn't necessarily say been squeezed out of the hedge fund market by the regulator, but close to it, very close to it. And that's very hard to, how can we can't deal with that. No. We simply have to go to another market, and we have to start afresh and building trust and confidence with investors in other markets.
Yeah, no, that's very true. On one hand, you're a successful fund manager. On the other hand, you're also an entrepreneur. You build a business from scratch. Did you always have the entrepreneurial gene inside you? Did you know that one day I want to have my own business?
I couldn't say I've always known that. On the other hand, I could probably say that I have probably always been a non-optimal employee. And over the past 15, 20 years, I've probably become even worse as an employee. I do like to do things in my way, and I do like to do push things in the direction that obviously I prefer. having said that, this is the only one and only company I've ever started up. Sure. So I couldn't very well call myself sort of a serial or actually experienced entrepreneur having started one company. There's a whole large number of people that started more. So, yeah.
Sure. And almost at the end, I asked my guests whether there is a fun fact that they can share about themselves, something that even people who might know you don't really know about you. Is there anything that springs to mind?
Well, I don't know. I don't know how fun it is, but I tend to think that probably in excess of 75% of my valuable insights and ideas, they're actually generated between the time I wake up each morning and the time I step out of the shower.
Okay, interesting.
I actually read a book on a related topic just a couple of years ago, and it turns out the human brain actually works pretty much that way. But some people prefer evening times. I strongly prefer morning times. I even have materials in the bathroom to take notes.
Sure. Fantastic. Excellent.
How fun it is, I don't know.
I think it's pretty fun, but last question to you, Anders. I said earlier that investors may not be asking the right questions. They fail to ask certain important questions. But what about today? What have I missed in our conversation? And what question should I have asked that I didn't?
Well, we talked for 2 hours, 20 minutes, so you covered quite a lot of ground.
Okay. As long as I've done you justice and IPM justice, that's what I want to make sure.
I mean, we talked, not a whole lot about business development and stuff, but that's not, that's our doing. That's not necessarily too interesting for your listeners. I think you covered it. We can take another 2 hours 20 next year and go to bottom with certain things.
Okay. Now, before we finish, what's the best place for people listening to this? Where can they reach and learn more about you and IPM?
Well, the best way is actually to get in touch with us, and that's very, very simple. Contact us via our website, which is ipm.se, and someone will be in touch with you.
Fantastic. Let me say to the people listening today that for those of them that are on the mailing list, there is a link in this week's email, and you can just click that link to say thank you to Anders. Thanks for sharing his story, his expertise, and I really do encourage everyone to do that. So let me be the first, Anders, to say thank you so much for all your time. It's been a fantastic conversation. I really appreciate your transparency and your willingness to share these insights and views on your strategy and your firm and some personal stuff as well. So that's been amazing. I really appreciate that.
Thank you very much, Niels. It's been a pleasure. It's rare that to have such a conversation over 2.5 hours almost with an interviewer with such insights into the business in general. So highly appreciated. Thank you.
Fantastic. Thank you so much. And of course, the listeners can also find all the details that we've talked about today in the show notes on toptradersunplugged.com. And I hope we can connect at a later stage, Anders, and get an update on all the great things happening in your firm.
Absolutely.
All right. Take care. All the best.
You too. Thanks.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.